Banks are failing, inflation is high, and people are starting to panic. If you're here, chances are you're worried about the recent happenings. You're wondering, is it safe to keep my money in the bank? Some financial experts warn that we might be headed toward another financial crisis like the one in 2008, or even worse. But don't hit the panic button just yet. Let's start with, how did we get into this mess? Let's dive into how our banking system actually works to better answer these questions. The Federal Reserve, aka the Fed, serves as the central bank in the United States and plays a crucial role in maintaining economic stability and promoting financial growth. How exactly does it work? The central banking system created by the Federal Reserve Act of 1913 was designed to steady the economy with the aim to create employment, stabilize prices, and moderate interest rates. The Fed accomplishes this by adjusting interest rates, buying and selling government securities, and regulating banks and financial institutions. They have what's called the Federal Open Market Committee, or FOMC, which is responsible for making monetary policy decisions. They meet 8 times a year to discuss economic conditions and decide on interest rates and other monetary policies. But that's not all. One of the key ways the Fed influences the economy is through its control over the money supply. They buy government securities in the open market to increase the money supply and stimulate economic growth, or sell these securities to reduce money supply and control inflation. Think of it as a gate. It swings open to allow a flow of money or swings shut to restrict the flow of money. That's what makes the Federal Reserve so important. Without a gate, the system falls apart. Money flow and securities isn't all that the Federal Reserve controls. It also plays a crucial role in regulating banks and other financial institutions. The Fed supervises and examines banks to ensure that they are operating safely. Did you know that banks take loans too? The Federal Reserve can serve as a full backup or backup plan that gives loans to banks during financial crisis. Banks borrowing money from other banks isn't the most surprising thing here. Banks also create loans out of the money you deposit with them. This is called fractional reserve banking. Banks lend out the money deposited by their customers to other customers or businesses, who then pay the loan back with interest. That's how banks make money. When you deposit your funds in a bank, that money doesn't just sit in a vault somewhere. Instead, a portion of it is kept in reserves, and the rest is used to make loans to individual customers or businesses who qualify. For example, if you were to deposit $1,000 into your bank account, the bank keeps some of it in reserve, around $100, and loans out the rest, around $900, to other customers. You heard that right. The bank is only required to hold 10% of the money in its reserves. While loans are expected to be repaid over time with interest per the loan agreement, there's a catch, which can be risky. What if those loans don't get paid back on time and in full? And what happens when something goes wrong? What if everyone wants to withdraw their deposits at the same time? Recall that we said banks keep some fraction of the money deposited and then loan or invest the rest. So it follows that only a fraction of bank deposits are required to be available for withdrawal. Consider this: if a large number of customers withdraw their funds at the same time, the bank may not have enough money in reserve to accommodate everyone. This could lead to a panic among the bank customers, causing them great concern. In response to this panic, more customers will then try to withdraw their money, causing even more chaos. This is called a bank run, and the FDIC and NCUA exist for just such a situation. For your safety and the bank's, there are some systems and organizations set up to safeguard your money if your bank or credit union were to go bankrupt. These organizations are known as the FDIC and NCUA. Here's how they help keep you protected. First, the Federal Deposit Insurance Corporation, or FDIC, is an independent federal government agency that provides insurance for bank deposits alone. This means that if your bank is FDIC insured and it goes bankrupt and closes, the FDIC insurance will cover your deposits up to $250,000 per depositor per bank. Similarly, the National Credit Union Administration, NCUA, is a federal agency that regulates and insures credit unions. So, if your credit union closes, the NCUA will also make your account whole up to $250,000 per depositor and per credit union. These two agencies insure deposits and help maintain public confidence in banks and credit unions. In fact, the creation of the FDIC in 1933 is one of the reasons that people felt comfortable leaving their money with banks after the Great Depression. However, not all banks and credit unions are FDIC or NCUA insured, so you'll need to check with your bank or credit union to ensure your deposits are covered by insurance. Remember that while FDIC and NCUA insurance can help protect your money if your bank or credit union shuts down, they won't protect you from other risks such as investment losses or fraud. So the burning question on your mind, is your money safe in the bank? The answer is yes. Your bank deposits are generally considered safe and secure if they are deposited at an FDIC-insured institution. If you're wondering, should I withdraw my money? This is what you need to know. Thanks to the FDIC insurance coverage, your bank deposits are generally safe and secure. So there is typically no need to withdraw your money from a bank account if you're concerned about its safety. However, if you're concerned about the stability of your bank due to news reports or rumor, you may want to consider opening an alternate bank account at another FDIC or NCUA insured institution. Just be sure to keep your total funds under the insured limit. Also, remember that withdrawing large amounts of cash can be risky and may not be the best course of action in all situations. For one thing, keeping large amounts of cash on hand is hard to physically secure and can make you a target for investigation or theft. Additionally, it can be time-consuming and inconvenient, especially if you have bills or other expenses directly tied to or deducted from your bank account. Are your bank deposits in jeopardy? Are we seeing a repeat of the 2008 financial crisis? There are certainly some concerning signals in the market. However, depositors at FDIC and NCUA insured banks should be assured by that guarantee that their deposits are protected in the event that their bank or credit union does face challenges in the future. With that said, it's always a good idea to keep an eye on the financial news. And if you have concerns, you can contact the bank directly for more information. Have you already heard some troubling news about your bank? Should you take all your money out in a panic? Well, we can't tell you what to do without knowing your specific situation, and frankly, that's none of our business. But if you're curious how best to manage your money and keep it safe, stay tuned for our next video. Remember to like and subscribe.